Banks are panicking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, it's about to get much worse for the banks, and I want you to see the shocking reason behind their latest move, because when you see the issues they're facing and how they're getting worse, well, you're going to understand why they're quietly trying to make some moves before they go completely insolvent. But before we get to that, we need to do some backstory from today's news. So let's head over to Bloomberg, where we picked today's story up with a headline: Fed Williams says he sees restrictive rates for some time. Now, we know the Fed is a big problem for the banks here. They've raised short-term interest rates. Long-term rates have not gone up, suggesting that the bond market does not buy into the growth and inflation story that the Fed has painted and for the markets to believe. And this is causing big problems for the banks. But many people have said, no, it doesn't look that bad. Well, underneath the covers, the banks know it's about to get much worse, and that not many of them may survive. Monetary policy is in a good place, Williams said. We've got the policy where it needs to be. Whether we need to adjust it in terms of the peak rate, suggesting that perhaps we've reached it, but also for how long we need to keep a restrictive stance is going to depend on the data. I expect that we will need to keep a restrictive stance for some time, he said. Now, what he means by that is even if we've achieved peak rates, meaning they have no intention to further raise the funds rate, what he's saying is we may need to leave it here for quite some time, because that's the level that we think may need to stay at to bring inflation down further. Of course, we're going to suggest to Williams that's not going to happen at all. The Fed's going to be cutting rates well ahead of what their expectations. And here we can see one of the reasons what the banks are dealing with right now is this threat of either that rates are going to stay high or perhaps even go higher. We come back to the yield curve, this shown in red, and anytime you see the red line underneath the horizontal black line, well, that indicates that short-term interest rates are higher than long-term rates. In fact, when you see the red line near the black line, because banks borrow at the short end of the curve and lend at the long end of the curve, when you see these inversions or near-term inversions, what it suggests is the banks can't make money lending. So they cherry pick who they're going to start lending to, which indicates here we see in the blue line the net percentage of domestic banks tightening standards for commercial and industrial loans for firms of all sizes. You see them tighten lending standards because it's not profitable for them to lend as much, so they have to curtail their activities. Now, we also know banks are the money centers in our economy. When they lend, they create new money into it. So when they stop lending or curtail lending, well, you start to run into a problem, which is why we tend to see recessions or financial crises always happen when banks start tightening lending standards. And here we can see perhaps a bit of a touch of what's coming for the banks that they already know. Now we're going to overlay the delinquency rate on commercial real estate loans, this shown in red, also on a year-over-year rate of change. And without any surprise, what we can see is that as banks start tightening lending standards, delinquency rates go up. And all this does is validate exactly how the monetary system works, because if there isn't enough new money being created to support not only the economic growth engine, but the existing debt, well, that means some people lose out. They are unable to pay their loan payments, and you start to see delinquencies rise. And so the banks already know that this is coming, and in a big way, because we just heard from Fed Williams, he says rates are going to stay restrictive, which means their yield curve could stay inverted for a long time, even though it's not. In his outlook, inflation returns to the central bank's goal of 2% over the next 2 years. I mean, we've got a long ways to go, and that means rates need to stay higher, even though they're not, as the economy comes into better balance. He said eventually monetary policy will need over the next few years to get back to a more normal, whatever that is, a more normal setting of policy, suggesting that the Fed funds rate is going to stay elevated for probably maybe a couple years in his view before they trim it back down to whatever that normal rate is, because we know the Fed has no clue what it is to begin with, which is a huge problem. But to suggest that inflation is going to stay hot, well, I think Williams needs to take a look at this chart here, where we have the consumer price index as shown in blue against the imports into the U.S. of goods and services, that's shown in red. both of them on a year-over-year rate of change. And what's critical here is you can see throughout history, when you are the largest importing nation in the world, when imports go down, it means demand's falling. And when demand falls, with a lag, you usually see inflation come down as well. It's telling us that even though we may not hit the Fed's 2% target in the next couple months, at the rate imports are collapsing, we are likely to see it far sooner than they think. And not echoing his sentiment, we see Fed's Bowman again says more hikes. They may be needed to lower inflation. So here you can see just this morning alone, the pressure the banks are under as they're looking for an escape valve. They're looking to get out of the situation they're in because they've not only have their treasury book that is upside down. We know they have unrealized losses there. So too does their loan book. Now the question is, which one of them would they rather hold if we go into a financial crisis or a recession? Well, of course, they're going to want to hold on to the treasuries, which might suggest what they're up to is because they know things are getting worse, particularly if the Fed has its way. I supported raising the federal funds rate at a July meeting, she said, and expected additional increases will likely be needed to lower inflation to the FOMC's goal. Now, of course, we know that Jay Powell, as the Fed's head chair of the Fed, has suggested that there should be one more rate hike this year. There still are a few meetings left, giving us the window to at least to believe that there could be a pause next month, followed by a hike, and then a pause in December. So all she's doing is sort of echoing the fact that maybe we need to go higher here, but we've already given that picture, got that picture from the Fed. I'll be looking for evidence that inflation is on the consistent and meaningful downward path, unlike the chart that actually suggests that it is, as I consider whether further increases in the federal funds rate will be needed and how long the federal funds rate will need to remain at a sufficiently restrictive level, which at least we now know they believe is there. On Friday, a Bureau of Labor Statistics report showed that non-farm payrolls increased 187,000 last month, less than forecast. The unemployment rate unexpectedly dropped to 3.5%, one of the lowest reading in decades. Of course, we know central bankers love to fixate on statistics that have no correlation with inflation, and the unemployment rate is one of them. But if we look into the data and see, is there a factor here in the labor market that will bring inflation down? And the answer is, oh yeah, and in a big way. Here we've got the consumer price index back, that's still in blue on a year-over-year rate of change. And now we're going to look at continuing claims. These are ongoing unemployment claims. And this is something we haven't compared to the CPI before. But what I want you to see is that as people go on unemployment and stay there, so this means they're unable to find work, you'll notice that the CPI, shown in blue, comes straight down. In fact, you can see it here in 1990s. And the continuing claims, it starts to rise, inflation continues, and the next thing you know, inflation's coming down. People are still on unemployment. You see that during the dot-com bubble. How about here again during the global financial crisis? And now, and this reason people are focused on this is fairly simple, because there's this broad belief that these continuing claims are going to come down. But in terms of inflation, one thing that's important to understand, the longer people are on unemployment, the less income they have. Less income means less discretionary spending, less growth, and that all turns to lower inflation. And this we now see today as treasuries kick off the week with losses. Not a good sign for the banks, again, suggesting they're going to have to make some big moves here. But one thing that shouldn't be facing losses, well, that's your trading account. Let's go back and take a look at one of our recent trades from our CTA-Timer Pro report. And what this does is it takes a look at machine positioning and then runs an historical overlay. And it said you should buy here. Now, many of you are looking at this saying, man, from a trade perspective, it was a little late. But nevertheless, one thing that's cool about our report, it has a very high hit rate. Here you can see as of today, it's moving higher as lumber prices head up. This is why we're in the lumber yard today, because here you can go back at July 13th. You can see we showed our subscribers that this had settled down. We've shown you this in the past, and next thing you know, the machines started buying up. That was your signal, and here you see it today on August 7th. While we see on the fast algorithm, they're slowing down a little bit today, What is critical is when they make the next move higher, and you see it's already, while it's a small trade, it's a positive trade looking to move higher, and you could add this to your arsenal and improve your trading today. And you can sign up. There's a link in the description. It's a mere $30 a month, and we've shown you one trade a year can pay for the whole subscription. It's important for investors to remain vigilant and not become complacent as the market's inflation and the Federal Reserve fears remain intact. Gasoline prices, this from Ryan Bellinger at Claro Advisors. He says gas prices have been rising in recent weeks, and Thursday's CPI report may reflect that. Well, inevitably, it probably will, which would boost the Fed's arguments for remaining aggressive with policy. Well, Ryan, I am so glad that you mentioned gasoline because it's one of my favorite data points to compare to the CPI, which suggests that perhaps the CPI is indeed coming down, and this little move higher in gas prices over the last couple of weeks won't make any difference. And here you can see the consumer price index in blue against the U.S. regular all formations gas price in red on a year-over-year rate of change. And you can see that gas prices tend to lead the CPI, not by a whole lot, but enough that it matters. And here you can see this is that little rise that Ryan's talking about there. But what he's missing is the CPI has got to factor all this big decline in gas prices. It's got to come down some more. It's my expectation that we'll see this week, and maybe the CPI will settle a bit here in the months to come, but this little transitory move higher in gasoline prices doesn't matter. Even hedge funds have ramped up their bearish treasury bets, putting banks under even more pressure as they attempt to drive yields higher. Again, and this all is coming back to when we get to the banks of why they're in this position and why they're desperate to get out of it, because they know things for them are going to get a whole lot worse. And meanwhile, these hedge funds boosted their treasury bets to a bearish bets to a record level as yields have surged. What we see is more traditional investors were burnt by having boosted wagers in the opposite direction and have bailed. But while these leveraged funds increased their net short positions of long maturity treasuries, what we can note is that asset managers have been taking the opposite side of the bet, taking their own net bullish positions to an all-time high. So what we have here is major bets on the treasury market. This is bad news for the banks. You see all these people want to drive yields higher, but asset managers, the smart money says, nah, I don't think that's the path. And they're right. Here we can see the net percentage of domestic banks tightening lending standards again for commercial industrial loans of all sizes against the 30-year treasury yields. Because remember, the 30-year bond, we just saw record short position. Everybody thinks the long bond is going down and the yields there are going higher. But you can see when banks tighten lending standards, yields tend to fall. In fact, it happens every time, except now everyone believes that this time yields are going higher. And one thing I want you to understand as we move into the banking story here is the reason yields fall during tight lending standard conditions is because the system needs to create money. So if tighter lending standards and higher interest rates are not leading to a large creation of new money, then interest rates in the system will start to fall regardless of how many people are betting against it, because the system needs to create new money or else the whole thing starts to collapse. And that's what the banks know. As property loans are now so unappealing, the banks, well, they want to dump them, and in a big way, but it's not going to be easy. This year's rise in borrowing costs has made commercial real estate one of the hardest hit areas in the economy, and we haven't even seen the full effects here. We have not even had that happen, but the banks know what's coming. I showed you the delinquency rate part, but wait, it gets worse. Property sales, especially for office buildings, have slowed to a trickle, giving landlords and lenders few markers to determine the value of certain assets. In the absence of transactions, stakeholders are closely watching the loan sale market to see what price banks can ultimately nab for some of the loans, suggesting they may get far less than they think. Banks have been eager to sell what they can, and at times shore up liquidity. So get this, what you're seeing here, or to avoid complicated situations that may crop up when a loan is maturing and needs to be refinanced. And what is this liquidity issue? That the banks need cash. And what are these complicated issues that the banks might be running into? Well, the fact that the borrower doesn't want to refi the loan or doesn't have the cash to bring the value of the property down, to bring the loan value down to the actual value of the property. These are issues that banks already see coming, and they want nothing to do with it, because if a recession hits, they're going to be stuck in a big way. For some lenders, taking a slight haircut now on the price may be better than running the risk that the lender has to foreclose, which we know if banks start foreclosing on commercial real estate, they are going to fail and ultimately end up stuck with the property, which isn't going to happen because they can't afford it. And here you can see what the banks also know is when you look at, again, when banks tighten lending standards. So here again, the standards for commercial industrial loans for firms of all sizes in blue against commercial real estate prices in the United States. Both are shown on a year-over-year rate of change. So what we can note, and there's not a whole lot of data, but going back to the global financial crisis, real estate prices actually contracted, suggesting that the banks are concerned that that's not only going to happen again just because of this cycle of tighter lending standards, but office buildings are nowhere near at capacity levels. There's less demand, and that means values have to fall, and the banks, they'll get stuck with these bad loans that will go into foreclosure, and it will lead to a domino effect of banks failing. And here you can see, even on a money creation standpoint, again, this is critical. Banks need people to borrow. We've looked at commercial industrial loans. We know that on a year-over-year rate of change, they go down as banks tighten lending standards because they can't originate enough new loans because they don't want to lend to anyone, thanks to the Fed inverting the yield curve, or the market, either way you look at it, not buying into the Fed's higher rates to deal with inflation story. So here we note that on net, these are going down. And what does that mean that banks would rather be holding right now? Well, if you said treasuries, you got it right. And some banks have tested the market on office loans, and they just can't hit the numbers. There's too much of a bid-ask spread, meaning what they want and what buyers are willing to pay. There's a large gap between them, and there's really nothing to talk about because agreeing to lower pricing would make these banks, and here's the key words from today's show, more insolvent. And this is why they're trying to dump these loans now, because they already know they're insolvent, but their books say that they're not. And if we actually see this come to fruition, we're going to see a whole lot of banks that many people said wouldn't be insolvent become that way. And another sector that's going to get a hit, of course, the banks are behind this one too. Well, that's home builders. Exuberant home builder rally runs counter to the housing market woes. Now, I want you to keep in mind, where do home builders get the money to start building homes before they sell them to people like you and I? Well, they go to the banks, and guess who's holding those loans too? Builders are in the business of building shelter capacity, and right now that capacity is very low. So they've got to build, and the headwind of the group is if shelter capacity that isn't bought by the home builders increases, and there's your problem that starts to crop up, is what if the buyers disappear? Who's holding the loan behind it? Of course, the banks. However, their fortunes could diminish, that's referring to the home builders, if dynamics in the existing home market shift. Not that many people actually believe that, suggesting that a drop in rental prices could entice potential home buyers into short-term leases instead of splurging on new houses. But yet they believe, and they falsely believe this, a dip in interest rates could also disrupt housing market dynamics. Notably, this would cause prospective buyers to seek new homes, except the problem is, what we can note is that if interest rates start to fall here, it means the economy is going into a recession, and the outcome here is bad. And already we've seen that higher interest rates have sent existing home sales lower in nearly every month since the start of the year. But is it really an interest rate problem? No, it's a tighter lending standard problem. It's an issue of the inverted yield curve. And here we can see new one-family homes for sale in the United States. We can see that when banks tighten lending standards, homes for sale go down in a remarkable way here. So if builders are building out more inventory, what's going to happen is they're going to find out that people can't buy it. Of course, a lot of these small and mid-sized lenders are holding these loans too. Problem is, can't offload these quite as easily. But now you know why they're trying to get rid of these commercial real estate bonds. They are desperate. They're in big trouble, and they already are insolvent, not on their books, but they know it's coming soon. And now, with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.